Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Hello everyone and welcome to Ask Rob and Rob, the show where you get your wonderful questions in and we do our very best to give you a half-decent answer. This week we've got questions in from Ash and Pete, but before we get to them, let's give you a quick reminder of how you can get your question on the show.
Yes, all you've got to do is call 013 808 0035. That's 013 808 0035. Or you can go to propertyhub.net/ask. Either way, you can leave us a voicemail and you'll hear your voice on this show at some point in the future, just like Ash is about to right now.
Hi, Rob and Rob. My name's Ash. I've been listening to your Property Hub podcast for a while now. Absolutely love the content and always looking forward to the next property market update, especially. It's really good that you put that in there as well now. So my question to you is, I listen to a lot of shares, news about shares and invested quite a bit in shares as well. There's some noise with the inflation rate and everything that's going on that within the next 1 to 2 years, there's going to be a recession. So this kind of goes the opposite way of we're going to see a boom in the property prices, at least for the next 2 to 3 years, the whole 18-year property cycle. So I wanted to know your views and thoughts about if there is a recession within the 1 to 2 years, would that impact the property prices? Will the property prices drop or not really? Yeah, so your views and thoughts about that would really help, because I'm in the process right now of purchasing property, but now I'm thinking, shall I hold off for at least 6 to 12 months if property prices potentially will drop due to a recession? Thank you so much.
Ash, thank you. That's a big question. There's a lot in there. So let's see what we can pull out. To start with, we need to separate a few different things, which is the stock market, the property market, and the economy. Obviously, these three things are all linked, but they're not completely tied to each other. I mean, just look at the COVID lockdowns. You had a recession, a huge recession, and yet the property market absolutely boomed. And many parts of the stock market did as well. So clearly, they are not always moving in the same direction at the same time. That's the first important thing to say. Next, let's look at the stock market. And the stock market is a funny one because it trades on this mix of actual fundamentals of the companies in the market and the profits they're generating and so on, but also sentiment and how much people are willing to pay today for anticipated future profits. So trying to work out what the stock market is going to do is extremely difficult. What you can say for sure is that inflation tends not to be a good thing for most companies, but what could put a real dent in the performance of the stock market is interest rates increasing. I've got a whole load of stuff in my book about this, so I won't go on about it for too long now. But the point is, if interest rates increase, that's going to be a headwind to the stock market. However, people assume that because inflation is high, therefore interest rates will be increased dramatically to try and bring that under control. As I go into in the book, that's not necessarily the case either. So while I don't anticipate that the years ahead are going to be particularly good for the stock market, I also don't think they're going to be that bad. Much of that applies to property as well, in that it seems like property prices are likely to cool from where they are now. But by that, I mean that the rate of growth will decrease, not that property prices are going to fall. For property prices to fall, you need a really radical shift in sentiment, and you also need some major changes to the lending market. You need lenders to be far less keen to lend. You need for them to be lending at higher rates, and you also need some repossessions. You need some forced sellers in the market. None of those things are looking likely at the moment, even if we technically have a recession. People tend to hear the word recession and think that that means house prices falling. That's not necessarily the case. If you go back and look at the past, sometimes they're related, sometimes they're not. Like I said, we've had a recession recently, house prices didn't fall. So my personal belief, and this is just an opinion, knowing what's going to happen in the future is really hard, and trying to predict it is a good way of looking silly, is that we may have a minor recession in terms of GDP falling, but I don't see it being a severe recession, and I don't see it having an impact on property prices. Talking about what it's going to do to the stock market is far more difficult because, well, you've got the US market and the UK market and all kinds of different categories of stocks. I won't say what it'll do to the stock market in general, but your question was about property. So I would say that even if there is a mild recession, which is possible, I don't think that is going to cause property prices to drop. That's one man's opinion. Shall we have a second man's opinion, Rob?
It's not going to change much, Rob. So I won't say much other than to say that if you look back through history, stock market corrections, falls of 10% plus, happen on average every couple of years, and crashes happen every sort of 5, 6, 7 years on average. The property market historically doesn't have those corrections and doesn't have that frequency of crashes. So history shows us that the two aren't really linked in performance. While there are obvious economic links, the actual outline performance of what takes place is very different. So just because the media is likely to talk more about a recession coming and then be very doom and gloom when it happens, we've had multiple recessions over the years. We've had multiple stock market corrections. We've had many, many stock market crashes and a lot less property crashes. And actually, in the past, property prices have accelerated while the stock market hasn't done so well, and vice versa. So I wouldn't get too hung up about it. And now you can switch off while the media tries to scare everyone. But thank you, Ash. Great question, and it helps us clear that up. Next up, we have a question, well, sort of, from Pete.
Hi, Rob and Rob. My name's Pete Edwards. Just wanted to ask you, are you aware of the rules from April 2024 relating to making tax digital and for landlords? Really, it's just to touch on this and let your listeners know that from that date, quarterly submissions are required and need to be submitted to HMRC. So any landlord with profits, rental income over £10,000 have to submit quarterly returns and then a final fifth return from that date. So that means having separate bank accounts, having software to enable digital recording of the rental profits. So it's a huge change in taxation and for landlords. And I think the sooner people can get ready for this, the better. Thanks, guys. Love it. Keep up the good work. Cheers.
Thank you, Pete. Not so much of a question, but a service to our podcast listeners. And to be honest, I'm sure I'd read this, but had pretty much forgotten about it. And it's probably because it's a little way off yet. But for those who like to be prepared, April 2024 is the date when things change. If your rental income is over £10,000 a year, which will apply to the majority of property investors, pretty much anybody with 2 properties or more, obviously depends on the type of properties, then you will have to submit quarterly returns. But working with a bookkeeper or an accountant is really simple. They will be able to do this for you. You've got great pieces of software like Xero, plus many more that can help with stuff like this as well. And to be fair to the government, they do put out a lot of information, a lot of videos on what you need to do. So you can head over to their website nearer the time to make sure you are prepared. So for those who like to be ahead of the game, you can start to do your research now and get yourself prepared. But for the majority of people, I wouldn't over worry. It's a long way off yet. It won't be that taxing when you get to that point. It is a bit more work to do, but the fact it's all online shouldn't make it too arduous for you. And it's just a little bit more work that needs to be done, but I don't think it needs to scare anyone. Just something to have in your diaries. Thank you, Pete, for making us aware.
Yes, indeed. I think it's just a bit more work, but you shouldn't be doing that work yourself anyway, because it's so much more efficient to work with an accountant or a bookkeeper, so they can do it for you. And if you have good basic practices in place, like having a separate account purely for your property portfolio, which you must, then really none of this should be that hard. So thank you, Pete. Thank you, Ash, for another couple of great questions. We'll be back to do it all again next week. But before that, we'll see you on Thursday for the Property Podcast. Have a great week. Bye-bye.
Bye-bye.